Bismillahirrahmanirrahim. This is the fifth video on financial statement analysis, and we will discuss the fourth, fifth, and sixth step of the six-step analysis and valuation process, that is, analyze profitability and risk, prepare forecasted financial statements, and value of the firm. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We have already discussed the first three steps of the six-step analytical framework that formed the foundational elements for analyzing and valuing a firm in the previous four videos. The first step was to understand the industry's economics where the firm operates. The second step was to understand the specific strategies the firm uses to compete. And the third step was to analyze the financial statements and assess their quality. In the fourth step, we will evaluate the firm's profitability, growth, and risk. Uh, so, investors they prioritize returns and manage risk. They buy stock for dividends and capital gains. Higher risk investments are expected to yield higher returns to offset the increased risk. The income statement displays a firm's net income over current and past years. Profitability is assessed by adjusting for one-time or unsustainable items. Analytical analysis includes examining revenue and earning growth to determine drivers of profitability and growth. This information aids in forecasting and future profitability. Research supports a strong correlation between earnings and stock returns. Financial statements assess a firm's risk. Earning volatility correlates with market based risk measures like market equity beta. Insufficient cash flow can lead to financial challenges and potential bankruptcy. High debt levels, if not managed properly, pose risk. Evaluating financial risk helps investors understand the risk of investing in a firm's common stock. Next, we will talk about the tools of profitability and risk. Now, common size financial statements express figures as percentage of total assets or revenues. In the balance sheet, we have the figures. We will talk about this in a while. And these figures are expressed in percentage as well. They facilitate analysis by showing each item relative importance within the overall finance structure. On a common size balance sheet, items are represented as a percentage of total assets, while on a common size income statement, Items are shown as a percentage of total revenues. So, interpreting these statements require careful consideration because dollar amount increases in items may not always lead to percentage increases. As changes in percentages can be influenced by overall changes in financial context, not just individual item fluctuations. For example, if an item's dollar amount grows, its percentage may decrease if the total assets or revenues grow at a faster rate. Common size statements provide insights into financial health and performance, but should be analyzed in conjunction with other financial metrics for complete understanding. For example, you can see that the receivables, they were 631 million in the year 2014 and 719 million in 2015. Despite this increase, the percentage of receivables relative to total assets decreases slightly from 5.9% to 5.8%. And the reason is that the total assets increased at a faster rate. Then, if you look from 2011 to 2015, the Starbucks relied more on liabilities to finance its operations, with the proportion increasing from 40% to 53.2% on common size statement. You can see here it increases from 40.4% to 53.2%. Current liabilities stayed steady, but there was a notable rise on the long term debt, showing increased borrowing over the period. Retained earning as a percentage of total assets decreased from 58.4% to 48% in the year 2015. Now, Starbucks common size income statement from the year 2011 to 2015 highlights fluctuations in net income as a percentage of total revenue. The net profit margin was consistently high up to the year 2013 when it dropped to 0.1%, attributed largely to litigation charges amounting to 18.7% of total revenues that year. Now, following the decline in 2013, Starbucks' net profit margin rebounded strongly to 14.4% in the year 2015. Analysts assess these percentages to gauge Starbucks' profitability trends, considering factors such as industry conditions, company strategies, accounting practices, management explanations, and comparisons with competitors. Next, let us talk about another analytical tool called percentage change financial statements. Now, percentage change financial statements indicate the growth or decline of financial statement amounts compared to previous years. They emphasize the rate of change in specific items over time, whether annually or across multiple periods. This tool helps in understanding how different financial statement items have grown relative to each other and in identifying trends in performance over time. Now, the rightmost column of the financial statement for the Starbucks from the year 2012 to 2015 shows percentage changes and balance sheet items. You can notice significant increases in assets like goodwill, indicating substantial changes in this category over the years. Long term debt shows some of the largest percentage increases amongst the liabilities. When analyzing percentage changes in balance sheets for a specific year, the starting base amount from the previous year is crucial. Smaller dollar amount changes can result in significant percentage changes, particularly when the initial amount is small. Look at the short term investments. They decreased from 135.4 million in the year 2014 to 81.3 million in 2015, a 40% decline. However, a large percentage change in an account that constitutes a small portion of total assets may not carry as much significance as a smaller percentage change in an account that represents a larger portion of total assets or financing. The rightmost column shows percentage changes in income statement amount for Starbucks. From 2013 to 2015, gross profit increased at a faster rate than the total revenue each year. This indicates effective management of cost of goods sold and possible strong pricing strategies. However, net income percentage change were more volatile over time, especially impacted by the litigation charges in the year 2013. Analysts will thoroughly investigate the reasons behind Starbucks' fluctuating profitability to understand the factors driving these changes. Next, we will talk about another analytical tool called financial statement ratios. Now, financial statement ratios are highly valuable for evaluating profitability and risk. These ratios analyze relationships among items from income statements, balance sheets, and cash flow statements. They serve as effective indicators of profitability, growth potential, and risk levels. Financial ratios are widely used by researchers and analysts to forecast future financial performance. Let us talk a bit about the different profitability ratios. And the first one is earning per share. This is a fundamental profitability ratio widely used in financial analysis. Basic earning per share for a company is calculated by dividing the net income available to common stockholders adjusted for preferred dividends by the weighted average number of common stock outstanding. For example, in the year 2015, the Starbucks reported a net income of 2757.4 million net income. So the net income was 2757.4 million, and if you look into the number of shares, this will be divided by, so 2757.4 divided by the number of shares, that is 1495.9 million shares. So the earning per share is 1.84. So companies typically disclose both basic and diluted earning per share on their income statements to reflect potential dilution from convertible securities. Then return on common stock calculates profitability as net income available to common stockholders divided by the average common shareholders equity. So if you look into, say, for the year 2015, uh, the net income was 2757.4275, and this will be divided by the average common stockholders equity or common shareholders equity. So if you look into the shareholders equity, that is 5818 plus 5272, average will be divided by 2, and this whole will be divided by the net income, that was 2757.4 million. So this will be equal to how much? This will be equal to about 49.7%. So a Starbucks achieved a notable return on capital on common stock of 49.7% in the year 2015, reflecting its strong position in the global coffee market and extensive store network. Analysts evaluate return on common equity over time to track performance trends and compare it with industry peers to assess competitiveness. Starbucks' profitability is enhanced by valuable brands that contribute to higher revenues and earnings, even though these brands' values are not explicitly listed on its balance sheet. Interpreting return on common stock effectively requires considerations of industry dynamics, strategic initiatives, and accounting practices to gain a comprehensive understanding of a company's financial health. To gauge the uncertainty in future earnings, analysts calculate the standard deviation of return on common equity over time. Analysts assess the ability to meet short term obligations using ratios like current ratio, that indicates relatively low or high short term liquidity risk, to evaluate the ability to avoid bankruptcy over the long term. Analysts consider ratios such as long term debt to common stockholders' equity. For example, at the end of the year 2015, the this ratio, the long term debts are how much? The long term debts you can see over here, mm, is 2003 2347.5 is the long term debt divided by the common shareholders equity, and the common shareholders equity is 5818. So this will give us a value of 0.4. So um, you can see here that despite there is an increase in the leverage, Starbucks' strong profitability, both liquidity and solvency ratios, so Starbucks have a strong profitability over here. So both liquidity and solvency ratios are meaningful when analyzed over time and compared with industry benchmarks. Understanding these steps require consideration of industry conditions, strategic decisions, and the quality of financial reporting. Next, we move on to the fifth and sixth step, that is prepare forecasted financial statements and the value of the firm. So, forecasting future financial performance is crucial in financial analysis and valuation, as it performs the foundation for valuation models and investment decisions. Analysts rely on several factors to make accurate forecast, like industry dynamics, that is understanding the industry environment and trends that could impact the firm's future operations, strategic choices, that is assessing the firm's strategic decisions and how they will influence revenue growth, cost structure, and market position, accounting practices, evaluating the quality and transparency of financial reporting to ensure accurate financial projections, financial ratios, that is analyzing key financial ratios to gauge profitability, liquidity, and solvency, providing insight into future financial health, making key informed assumptions about factors like revenue growth, cost management, pricing strategies, and investment in assets, and then finally estimating the amount of capital needed for growth, potential changes in financing structure, debt versus equity, and the impact of leverage on financial risk. Overall, the reliability of forecast determines the quality of investment decisions, requiring a comprehensive analysis of industry trends, strategic plans, financial data, and assumptions about future conditions. Forecasting income statements, balance sheets, and statements of cash flows is crucial in financial analysis. It involves basis of forecasting, that is responses to strategic questions form the basis of predicting future financial performance. Comparative analysis. Analysts compare financial ratios derived from forecasted statements with those from reported financial statements to validate assumptions. Techniques and applications. This includes methods for projecting future financial statements, applying these techniques to build reliable projections. Valuation foundation, that is, forecasted financial statements provide the core data used in valuation models guiding investment decisions. So, in essence, accurate forecasting relies on strategic insights and rigorous analysis, ensuring projections aligned with historical performance and industry expectations. Now, financial statement analysis is primarily used by capital market participants to value the firms. The steps leading up to valuation culminate in the creation of a valuation model. The key point includes role of financial statement analysis. It serves as the foundation for valuing firms in capital markets. Importance of forecasting, that is, forecast of future earnings, dividends, and cash flows are crucial for accurate firm valuation. Purpose of valuation to make informed investment decisions based on reliable forecast of profitability, growth, and risk. And financial models, or sorry, valuation models, these models rely on forecasts of dividends, earnings, and cash flows to determine firms' value. So, in essence, financial statement analysis and accurate forecasting are essential for creating reliable valuation models that guide investment decisions. So, this completes the fifth video on financial statement analysis. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.